Now, most traders, they don't fail because they lack strategy. They fail because they don't follow one. So before we build this trade plan out here today, understand this. If you keep trading without structure, you already know how it ends. Now, open up your Word document or your document, whichever app you use, and let's go ahead and build our trade plan today. Number one, we need to understand, what are we trading? We have stocks, we have options, we have crypto, we have Forex, so many types of things to trade. So on your trade plan, go out here, write it down. I'll be trading, let's say, for example, stocks and options. You don't need to do both of them. This is just an example. You could only be trading stocks, or you could only be trading options, or you could be trading stocks and options. Let's go to number two, your trading style. There are so many different types or styles of trading. You have scalpers, you have day traders, you have swing traders, all that. Now, come back to your trading plan. Write down, my trading style, I'm going to be a swing trader, okay? Let's go to number three, your time frame. Yes, you can trade everything, but that's exactly why you're inconsistent. You have different time frames, 15, 30, 1 hour, 4, daily, weekly, monthly. So many time frames out here. The key thing for you and your trade plan is to identify the time frame that you will be trading, and that's what you're going to stick with. So, a good example, you could say here, let's say the daily or the weekly or the monthly time frame, okay? Now, here's a thing that I really like to bring up, because I find at times some people who are new to trading, they're going to try and trade a 15-minute chart, a 5-minute, a 10-minute chart, but they're expecting these huge stock moves which happen when you're trading a higher time frame. So you cannot trade a lower time frame and expect higher time frame results. It doesn't work. So on your trade plan, write it down. I'll be trading these time frames. If it's the daily, the weekly, the monthly, you can write down, even if you're a scalper, 15-minute, 10-minute, write that down on your trading plan. You do the type of time frame that you like, that you prefer, but the key thing here is to write it down. Let's go to our strategy. So many strategies out here again. You have breakouts, you have retests, you have patterns, you have all that stuff. I know it sounds simple, right? But this is exactly where people mess up as well, because they try to trade everything under the stars. Now, the rule here is that if it's not your setup, you don't trade it, because this can lead to you overtrading, and that's the fastest way to blow up your account. So let's go back to our trading plan. My strategy is going to be, write it down here. You can say you're going to be looking out for breakouts, a breakout, retests, etc. Just as long as you find that strategy and you write it down. Doesn't have to be breakouts or all that stuff. As long as you find a strategy and you write it down. Let's go to the entry. Now, your entry is not going to be random. It's not whack-a-mole. It's going to be rule-based. Your entries can be examples, SMAs, let's say the daily 21, the daily 200. It could be a trend line that you like. It could be volume. It could be a crossover of moving averages. So many entries out there. And the key thing here to understand is that you don't need more indicators. You just need consistency. Because the key thing here with entry rules is that it has to be the same setup that you're going to trade over and over again. So let's go back to our trade plan and write my entry game plan is going to be, example, daily 21. Okay. Now, the next two things, they confuse a lot of traders over and over again. Number one, stop loss, and number two, trade invalidation. Now, let's discuss the differences between the two. A stop loss, this is the execution of an order to exit a trade. Okay? But beginners, they make mistakes. They start moving stops. They start, guessing. They start panicking. And that's not trading. That's reacting to a trade that you're already in. And so many emotions are going to be in it because let's say you're losing money. Now you are reacting. Okay? So if your entry was at the daily 21, you could set up a stop loss order right below, let's say below the daily 21 or something like that, or minus 1 hour. And these are just examples. If you're trading calls, you can say your stop loss is going to be the previous low. If you're trading calls, if you're trading puts, let's say your stop loss is going to be a previous high if you're trading puts. Because, if you're trading puts, you want the price to go down. You don't want the price to keep going up. If you're trading calls, you want the price to go up. You don't want the price to go down, okay? Now, let's talk about trade invalidation. Now, trade invalidation, this is the logic of your trade idea. This is where if it goes south, you accept the fact that your trade idea was wrong. At what point is your trade idea wrong? That's your trade invalidation. And it tells you, don't re-enter that trade. That trade idea was wrong. That stock is not moving in your favor. So invalidation is where you admit, I'm wrong. This trade idea is wrong. And the stop loss that you have is how you enforce this. Now, let me give an example of this. Let's say you're buying, let's say stock A, its price is $100. And you buy one contract, let's say at $2, okay? Now, your stop, let's say you're trading calls, you're expecting the price to go up, right? So your stop, let's say you're going to put it at $97. And trade invalidation, where the idea is wrong, like literally wrong, is if this stocks, let's say it breaks $95, okay? So such an example to help you understand the concept between stop loss and trade invalidation, all right? Now, let's talk about profit target. The key thing here that I keep advocating for is understanding risk and reward, because you cannot be risking one to get one. You'll never get anywhere. A lot of people, they risk one to get two. I personally prefer risk reward 1:3 plus. All right. So let me write that down. Risk reward of 1:3 plus. Now, at times you enter a trade, it works out very well and you have very high rewards. Example, let's say 1:5 or even higher. And the good thing about this is that it helps you because you don't need to win a lot. You just need your winners to be big enough to act as a cushion for your losses. Because in trading, losses are going to be there. But here's a key thing. If your risk reward, let's say, is 1:5, and you enter maybe one trade, it has a loss of -1 R. You enter another trade, has a loss of -1 R, and so on and so forth. At the end of this, your first trade was 1:5, right? And you have two losses, -1 R. So you still have what? You still have R3. So that's the whole concept here. The goal is for your winners to be big enough, letting your winners run and cutting your losses really fast. So that's the whole concept of profit targets. Have bigger wins often and cut your losses faster so that you can still have rewarding benefits from trading. Okay, now let's talk about risk management. This is essentially what keeps you alive in this game, because I've seen traders, novice traders, they get into a trade and they're risking almost 60, 70, 80, 90% of their account on one trade. You cannot put all your eggs in one basket. You cannot expose yourself to that extent, because if that trade goes wrong, you're out. And that's not trading, that's gambling. Let's say, for example, you have a $5,000 account. You cannot be risking 4,000 of that, because if that trade is invalidated, it goes south, the trade idea was wrong, what happens? You lost all your money on one trade. How are you going to keep trading if your account is game over? Okay? So, I hope you understand that. I hope this trade plan helps you update your trade plan. And if you don't have a trade plan, I hope this trade plan can help you develop one that you're going to follow and you're going to finally be successful in trading. Because the goal isn't to get rich fast. It's to survive long enough to become profitable. And understand this, guys. You don't blow accounts from bad trades. Remember this example we gave here. You can have 1, 2, 3 losses, but you still had 1 or 2 trades that gave you a higher reward. So you don't blow accounts from bad trades. You blow accounts from bad risk management. So I hope this helps you out. Thank you for watching.